All right, earnings season is starting, as you can see in our calendar by implied move. A lot of very famous names are reporting next week. So, as you know, we like earnings not necessarily just on the season, but for the repeatability of the edge and the data-driven perspective it gives us. So let's dive into what opportunities we can study this week and see how volatility is shaping up for some of these names. All right, welcome to this video where, as usual, we do a deep dive on some volatility strategies for earnings. So let's go ahead and dive into some more numbers. Here we open our interactive calendar from the EarningsWatcher platform. Let's go ahead and directly filter by a full week and only keep liquid options that are comfortably tradable. And then we can do all sort of sorting by with these columns. Let's actually do something very simple. Let's start by looking at the implied moves themselves, which ones are the highest and how they're shaping up for the full week. We notice here an interesting name, Intel, that is popping as the highest implied move of the week. Compare this, so this plus minus 12.6%, nearly double the average move basically that we see here. This is the average move over 10-year period of 7.8 and a decent standard deviation of 4.8. So this seems to be already a volatile stock, but the current expectations are even higher. So let's directly dive in and basically open its moves analyzer to dive more into the past numbers, the past trends, what happened and what's behind basically this high up implied move. Now here we see in the moves analyzer, so we start by the past moves breakdown. This really looks at all past releases since 2013. And we see basically what's important for us is really how the day of release move, the actual move, the realized move, compared to this implied move. Let's scroll down directly to see some numbers. So we see that since 2013, if we really look at the whole period, this is the number that we saw in the calendar, we see this average and standard deviation, an average of plus minus 7.8%. However, let's go ahead and directly filter for the last just 2 years and see how these numbers shape up now. And this is what's really interesting. We see that now this average is at around 12%, nearly doubled the 10-year period. So Intel seems to be a somewhat volatile stock overall over the last 10 years. But if we focus on really just the last 2 years, things have gone even higher, which is sort of expected since they have been more in the news, especially recently with this equity stake that happened. And so it seems that it's being more and more volatile. However, the interesting thing is what we looked at. The first number, remember, is the current implied move, which is really quite high, the highest of the week for these types of stocks, plus minus 12.7%. Now, if we compare it to the average over just the last 2 years, it makes sense. We see that it's clearly very close to that, much closer than when we looked at the 10-year period. But the interesting aspect is that, as we noted, we don't see many shades of blue here. We don't see a lot of dates with the actual move beating the implied. It really seems that the implied move is a bit overvaluing the actual reaction on earnings day. It seems that the market is trying to account for this recent volatility, but it's not successfully doing so. And so this is a bit confirmed when we scroll down and we look at this breakdown here of the how the actual move compared to the implied move. We see that on some occasions, sure, the actual move does beat the implied, but when it does, basically, it doesn't so by a lot. However, the misses that happened in the last 2 years seem to be more consequential, and especially the average value of them seems to be higher. This is what is confirmed, and when you look down in these numbers, if you follow our videos, you'll be familiar with these statistics we look at. This left number here really tells us, okay, when Intel actually beats its implied move, what's the average value by which it does so? We see that, okay, it's just 2%. However, when it doesn't beat, when it misses, when the actual move is lower than the implied move, what's the difference there? Well, we see that it's 5.5. Usually, when we want to play long volatility, when we bet on basically against IV crush, we bet that the move will be consequential and big enough to actually beat the IV crush. We want the left number to be higher than the right number. Basically, we want when there is a beat, the move to be quite high to profit from, and when there is not a beat, when it misses, we want it to be quite low so that our losses are reduced. Here, funny enough, and this is what really studying the numbers allow us to do, is that even with this recent volatility for Intel, well, it doesn't seem that the market really is well pricing that. It seems that the market is overvaluing its reactions on earnings. And so overall, even with this uptrend in volatility for Intel, the market expectations is failing to account for it. And as you can see, most of the releases have been underwhelming or under that implied move. And so it sort of seems that Intel is a decent candidate for short volatility of here, actually agreeing with the market and selling options to profit from IV crush. And so let's go ahead and simulate what different positions we can play for Intel given these setups. Here we open our simulator. This is a very important step in this research, where now we'd like to actually study actual options positions and see how they're looking, at what types of returns and likelihood, etc. we can get. And the important aspect is that we want to model that IV crush, how IV of every option, every strike and expiration will behave after the release. As you know, this is what's behind the implied move, basically. So now for Intel, we discussed how we are interested in these short volatility, so selling options to profit from IV crush. And here the classic positions would be, so rather than buying the straddle, actually to sell it. So we can click directly on classic strategies and open pre-configured positions for these long or short. Let's start by the basics. So the short straddle, selling the call and put closest at the money. So here you see the 36.5 call, 36.5 put. You see, as we discussed, it's IV currently at 100.8, 108.9 will drop to 69%. And so what's important for us really more than these numbers is how they translate into actual P&Ls in a likelihood of success, etc. This is what we'll be able to do as we scroll down. We notice, first of all, the break even that we were looking at now in more details, plus minus 12.3 and 12.6. And we see this price simulation that again takes into account different parameters and especially the IV crush. We see the very close, very best scenario for us for short volatility of really the stock not moving at all. And so basically the position that we will sell here, you see for $4.6, we'll be able to buy it back by Friday. So this is the first day of trading after release for Intel. We'll be able to buy it back just for 96 cents. And so pocket all the difference for a 79% return. However, again, this is a very unlikely scenario. This is really the stock not moving at all. We want to know, okay, what is our exposure, basically, what's the type of loss that we can also see. And this is what we can do by moving the sliders. And so let's go ahead and test bad scenarios. For example, the move actually breaching our break even and here arriving, let's say, at 18 or 20%. Remember, we saw in the past moves breakdown, one of the biggest moves that happened was the 30%. Basically, that's a bit of an outlier. It was during a very specific time, but it only happened very few times. But let's still account for it and see how it impacts our position. And so as we move the slider to that 21-22%, we see a bit substantial loss. It's 78%. So basically what we sold for $4.6, now we have to buy back for 8.2. This sort of makes us paying us a P&L of losing 78%. And so we see this inherent big loss that comes with these positions. Again, the break even is very favorable for us. By the way, notice how there is a big risk. Also, there is a big reward coming with it. But especially what's good for these positions is that the likelihood of success is quite high. This is what we see as we look basically at the section where we compare our current break even, so this plus minus 12%, to the distribution of past moves. And here the good thing is that you see how our current break even basically sits really at the edge of this distribution of past moves, meaning that most of the past moves have happened within this plus minus 12.3, 12.6%. And this is a good sign, basically reassuring for short volatility plays. Now, obviously, there are values that happen outside. For example, you see here a stock move of 11% that happened twice, in even this wild occurrence of very outlier number of the 30% that happened once. So this is what we need to be careful for. But overall, this means that the win rate basically the historic win rate back test type of analysis, the likelihood of success basically is quite high. We quantify it here to 69%, meaning that this trade has a high probability of being profitable. But again, you need to be careful with this loss figure if you choose to go with this position. Now, quickly, another variation of the short straddle, as you imagine, is the short strangle. So going out of the money now with these legs. So you can see 41 call, 32 put, and notice right away. So it is a cheaper position. It will make us $1.47 basically when we sell it, and we'll be able to buy it back again. Best case scenario, as expected, for really zero peanuts. These out of the money legs will basically become worthless if from Ivy Crush if the stock does not move a lot. And so the good thing about strangles is this wide break even. And as we scroll down, notice how now our likelihood of success is even higher. And the break even really sits at the most edges of our distribution. So most of the past moves are encapsulated and basically will make for a win in our case. However, as you expect from strangles, there is no free lunch. And we said there's always a downside for whatever advantage we get. If we simulate that big move of 2022, 25%, etc., you see the loss is nothing to joke with. 200% loss, meaning what we sold for $1, so $147, we'll have to buy it back for $400. This is the risk that comes with these wide strangles. Now, a lot of people like to play these strategies as it has some advantages, this very high break even, this very high win rate also, but really careful of you want to do this on stocks where you really study the risk and the potential really bad scenario of it and be ready for that type of loss. It seems here that Intel, again, even though it is somewhat a volatile stock and has been more volatile, the expectations of the market are even more bigger and wider than that. So perhaps it is a decent, again, a candidate for these types of strategies. And the advantage of earnings that you're seeing here is really the ability to find plays that suits you and suit your risk reward, whether you're more focused on a very high win rate or a very high risk reward, or you're not comfortable with this risk and reward and you want to go with more conservative positions. Let's wrap it up by looking at such positions. This is what we call butterflies, basically transforming our short straddle to actually add to it a long strangle. So it's as if there are spreads in each direction. And so we are capping basically our exposure. So you see here in our pre-configured list, we can browse through different positions. And let's open one of them, for example. You see how the short position is still the main one. It's still this short 36.5 call and put. However, now we bought wider legs, so a wider strangle out of the money, 32.5 put and 40.5 call, really to cap basically our position. And you will see here the different advantages and disadvantages. The problem, or sort of one drawback that we had to pay for, is this lower break even. We're not at those plus minus 12% anymore. We had to get now a break even that's a bit tighter. But as we scroll down to the likelihood of success, it's still decent enough. Sure, we have some values outside of it to the right side and left side. So we are not as protected, or we don't have a high win rate as we did with the short strangle and straddle, but still quite decent at 56%. Now, as you imagine, the big advantage is this capping the loss, where we won't be exposed to these 100 to 100% losses. And so if let's simulate here a breach of our break even, you see here even at 20%, where the move is twice the level of break even, you would think we would be decimated, or a short strangle would be decimated in this case. For this butterfly, you see the loss is somewhat capped, somewhat normal, 34%. So what we sold for $2.93, we'll have to buy back for $3.94. So putting in an extra $100 basically per contract on this position, and not as tragic as the short strangle. And especially this number is capped. So as the move keeps going up, if the stock keeps going up 30%, 40%, 50%, really doesn't matter. Our loss stays at that 34, 35% figure, which makes sense because there are spreads in each direction. So whatever happens, one leg will compensate for the other. And this is really the advantage of having these butterfly or iron condor structures. So again, this is, to wrap up, this is a good example of how we like earnings, because they allow us to find plays wherever our risk profile is. So whether you're focusing on really the highest win rate possible or the highest likelihood possible, or you're more conservative and you'd like to not risk that much in your position, basically earnings, and not just earnings season, really earnings happening week after week, this repeatability and data-driven edge of it is really what we like. Is if and the idea is that, as you can see here with Intel, thorough analysis through the numbers, etc., allow us to find these opportunities and calibrate something we're very comfortable with. And so what we can do also in the platform is to practice and, be ready, test different entry, exits, and sizing, etc. You can paper trade the position directly so that you can refine your approach of how you would do things in real life if you're not very comfortable with these things yet. As a recap, so sort of a use case of we focused on, again, these strategies going through earnings, long and short volatility. Keep in mind, a lot happens before earnings. This is IV rush that we talk about in other videos, as well as momentum that happens after earnings. Again, just goes to show you the edge of earnings and how the type of opportunities that are available. And again, we emphasize the repeatability, the data-driven aspect of it that allows us to find these opportunities. Hope this was helpful. Thank you for watching. Don't hesitate if you have any questions, and see you in the next video.